Hey everyone, Domino's reported quarterly financial results that sent the stock price down almost 14% on the news. I'll review those financial numbers and I'll highlight specifically the factor that caused the stock price to fall by so much. I'll also update my buy recommendation for Domino's stock and let you know if the stock is an excellent buy on this dip here. So that's a lot to cover in one video. Let's get right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, Domino's reported global retail sales growth of 7.2% with same-store sales growth of 4.8%. International same-store sales growth were just 2.1% and global net store growth of 175. This store growth, I'm going to foreshadow, was the primary cause of Domino's stock price falling after the announcement. Not this specific number, but a forecast for future store growth that hurt Domino's expectations in the future. I'll get to that a little bit later in the video in more detail. Domino's CEO saying, for the second straight quarter, we drove U.S. comp performance in the healthiest way possible through profitable order count growth. We had positive order counts in our delivery and carry-out businesses and across all income cohorts. And that's what you like to hear as an investor. The company is growing revenue and sales in the most healthy way possible, not by offering increasing discounts and promotions and lowering prices to generate sales growth, but generating sales growth organically through better products matching customer desires and fitting the need that customers desire. So that's where you want to see growth profitably. And that's precisely what Domino's delivered in the latest quarter. So drilling down on the details of their growth, global retail sales growth came in at 7.2% in the second quarter. That number was just 5.8% in the same quarter the prior year. So Domino's is increasing the rate of growth. And that's similar for the first half of the year. 7.3% growth on top of 5.8% growth in the same time the prior year. So again, accelerating revenue growth. Now, if you're not already aware, Domino's runs a franchise business model, meaning the vast majority of its locations are owned by franchisees. Okay, so keep that in mind here. Their U.S. franchise stores increased revenue by 4.8%. And for the first half of the year, they've grown revenue by 5.2%. That's an acceleration from the same times last year, where they were negative 0.1% in the same quarter last year, and just 1.6% growth in the two fiscal quarters of 2023. Remember, the big overlying factor for Domino's was the change in consumer behavior as a result of the pandemic. Domino's benefited tremendously as people were spending more time at home and dining out was restricted. So Domino's benefited. It's like the business was tailor-made for the pandemic, right? You order Domino's for delivery, and that business model was so beneficial for Domino's during those lockdown stages and the earlier stages of the pandemic. And then in 2023, those trends reversed, right? People wanted to go out more. People felt a little bit of pizza fatigue. And so its growth slowed down considerably in 2023. So it's healthy for investors to see growth accelerate again following that difficult comparison year in 2023. And now you're seeing growth rebound, and that's great news. International growth is not as robust. Just 2.1% in the second quarter compared to 3.6%, and just 1.5% in the first half of the year compared to 2.3% in the same part last year. The international segment is plagued by several headwinds, including devastations in the Russian market based on one of its franchisees that's filed for bankruptcy there. And so they're looking at that as all those stores are going to be closed. And then the wars in the Middle East. And then on top of that, you've got growth in the region, slower growth in Europe that's slower than growth in the US. So all those factors playing a role for slower growth for Domino's in international segments. Domino's is primarily franchisee owned, and they own only roughly 289 of their 20,900 locations. That's all that Domino's owns, and they own it primarily for proof of concept, for testing strategies and things that they can teach their franchisees. And so they test them in those 290 stores that they own, and they model the best practices and they test them in those locations, and then they make the franchisees aware of these best practices and so they can implement them. So 20,930 locations as of June 16th. That was up by roughly 175 in the quarter. So store growth is slowing down. Trailing 4 quarters net store growth came in at 725. But if you exclude the Russian market, which had that bankruptcy, it would have been 868 stores added in the trailing 4 quarters. And Domino's management has said there's room for continued expansion. They think they can add thousands more locations worldwide as appetite for its product is increasing. So one of the benefits of this franchisee business model is that it generates strong cash flow because Domino's doesn't need to put up the capital to open each new location, right? Imagine if Domino's had to put up the money for each new location, then that would hinder its growth capability and its cash generating capability because it would be continuously investing in new locations, right? But it doesn't need to do that. The franchisee puts up the capital for those new locations, and that helps Domino's growth. And so cash flow from operations came in at $274 million, which was up by 13.2% compared to the same 2 fiscal quarters last year. And then free cash flow also increased by 13%, up to $230 million. Looking ahead longer term, Domino's forecast for the years 2024 to 2028 is for 7% annual global retail sales growth and 8% annual income from operations growth. Now, here's the troubles, and here's the area that caused Domino's stock price to fall. The company expects it will fall 100 to 275 stores below its 2024 goal of 925 plus net stores in international. And this is primarily a result of challenges in both openings and closures being faced by Domino's Pizza Enterprises, which is one of its master franchisees. So one big franchisee, which has many, many locations, is facing significant difficulty. And so because that franchisee is not opening as many stores as Domino's thought they would, that's going to cause the company to fall short of their targets for net store growth this year. Furthermore, the company is temporarily suspending its guidance for 1,100 plus global net store growth until the full effect of this franchisee's store openings and closures on international net sales growth are known. And so the combination of these two things are what caused Domino's stock price to fall considerably following these announcements. Domino's stock price was down 13.77% on the day of this news. Domino's is now trading at a forward price to earnings of 22.56, which is on the lower end of where this stock has traded for, going all the way back to late 2021 and early 2022. So to answer the question, is this a buying opportunity for Domino stock investors? I say the answer is yes. The company has an excellent business model that's working really well. This headwind with one major franchisee is a short-term issue. And if this franchisee has greater difficulty, I wouldn't be surprised if another franchisee or a group of franchisees steps up and capitalizes on the opportunity. So longer term, I do like Domino's stock for passive income investors. I like the business model. I think it's a good value here at these valuations. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience.